What are the tax implications of selling option shares? Have you ever wondered what happens to your taxes when you sell shares that you acquired through exercising options? The tax situation can be a bit tricky, but understanding it can save you money and headaches down the road. Let's break it down in simple terms. First off, when you exercise an option to buy stock, you usually do not owe any taxes at that moment. This is true for most physical settlements. Your holding period for the stock starts from the exercise date. This period is important because it determines how your profits will be taxed when you eventually sell the shares. Now, when you sell those shares, you will face capital gains tax on any profit. This profit is calculated as the difference between the sale price and your cost basis, which is typically the exercise price plus any amount you paid for the option. The tax rate you pay depends on how long you held the shares after exercising the option. If you sell the shares within 1 year of exercising the option, you will incur short-term capital gains tax. This tax is charged at your ordinary income tax rates. On the other hand, if you hold the shares for more than 1 year after exercising, you qualify for long-term capital gains tax, which is generally lower. Different types of options have different tax rules. For non-qualified stock options, when you exercise them, the difference between the exercise price and the fair market value of the stock is treated as ordinary income. This means you will pay income tax and payroll taxes on that amount. When you sell the shares later, any additional gain or loss is taxed as capital gain or loss based on how long you held the shares. Incentive stock options have a different set of rules. You usually do not pay regular income tax at the time of exercise. However, exercising these options may trigger the alternative minimum tax. If you sell shares acquired through incentive stock options, the gain is taxed as a capital gain if you meet certain holding period requirements. This means holding the shares for more than 1 year after exercising and 2 years after the grant date. If you do not meet these requirements, it is considered a disqualifying disposition, and part of the gain will be taxed as ordinary income. If you sell an option contract instead of exercising it, any gain or loss is generally treated as a short-term capital gain or loss, regardless of how long you held the option. If the option expires worthless, the premium received is treated as a short-term capital gain. When selling shares, keep in mind that you need to track your cost basis carefully. For instance, if you sold a put option that was exercised, the premium you received reduces your cost basis in the stock you are required to buy. Conversely, if you sold a call option that was exercised, the premium you received is added to the sale proceeds of the stock you deliver. To sum it all up, selling shares obtained through exercising options can lead to capital gains tax based on how long you held those shares. For certain options, you may also face ordinary income tax at the time of exercise. It is always a good idea to keep detailed records and consult a tax professional for more complex situations, especially if you are dealing with incentive stock options or large transactions. Understanding these tax rules can help you navigate the world of options trading more effectively.